You know what's fascinating? While everyone's watching the gold price tick up and down on their screens, there's an entirely different game being played behind the scenes. And I'm not talking about some conspiracy theory here. I'm talking about documented, verifiable moves by the world's largest institutions that most retail gold holders have absolutely no idea are happening right now. Let me paint you a picture of what I discovered last week while digging through central bank reports and COMEX data. The Chinese central bank just reported their 18th consecutive month of gold purchases. 18 months. But here's what nobody's talking about. The tonnage they're reporting, it doesn't match the physical flows we're seeing through Swiss refineries. Not even close. Switzerland is the gold refining capital of the world. Almost all gold that moves from west to east gets refined there first, and the Swiss customs data shows something remarkable. In the last quarter alone, over 400 tons of gold flowed from Swiss refineries to China and India. 400 tons. But if you add up what central banks are officially reporting, you get maybe half that number. So where's the rest going? That's the question that should keep every gold holder awake at night. Because what we're witnessing isn't just central bank buying. It's a fundamental restructuring of the global monetary system, and it's happening in plain sight while most people are completely oblivious. Think about this for a second. For the last 50 years, since Nixon closed the gold window in 1971, we've lived in a world where currencies float freely against each other, backed by nothing but government promises and military might. The dollar became the world's reserve currency, not because of gold backing, but because of oil. Every country needed dollars to buy oil. That was the deal Kissinger struck with Saudi Arabia in 1974. But that system? It's cracking, and gold is at the center of what comes next. Let me take you back to something that happened in 2011 that most people have completely forgotten. Germany asked the Federal Reserve to return 300 tons of their gold that was stored in New York vaults. Simple request, right? It's their gold. They want it back. The Fed's response? Sure, but it's going to take 7 years. 7 years to return gold that's supposedly sitting in a vault. Think about that. If I asked you to return my car that's parked in your garage, and you said it would take 7 years, what would that tell you? Either the car isn't there, or you've lent it to someone else, or something very strange is going on. Germany eventually got their gold back, but it took until 2017. And when metallurgists examined some of the bars, they found something interesting. The serial numbers didn't match the original bars Germany had deposited. The gold was there, sure, but it wasn't the same physical gold. It had been melted down and recast. Now, why would that matter? Why would anyone go through the trouble of melting and recasting gold bars? Unless those original bars had been leased out, sold, or otherwise encumbered. Unless the Fed had to scramble to source physical gold from somewhere else to make good on Germany's request. This is the world of paper gold versus physical gold. And understanding this distinction is absolutely critical to understanding what's happening right now. See, when you look at the gold market, you're really looking at two completely different markets that trade at roughly the same price. There's the physical market, where actual metal changes hands. Bars and vaults, coins and safes, real, tangible gold. And then there's the paper market, where contracts representing gold trade back and forth. Futures contracts, ETFs, unallocated accounts, derivatives. The paper market is massive. For every ounce of physical gold that exists, there are probably 100 paper claims on that same ounce, maybe more. Nobody knows the exact number because the system is deliberately opaque, but we know it's a lot. And here's the thing about paper gold. It works great as long as everyone's happy to trade paper. As long as nobody actually wants to take delivery of physical metal, the system hums along just fine. You can create infinite paper claims on the same physical gold. And as long as people are content to settle in cash, nobody's the wiser. But what happens when people start wanting the actual metal? What happens when central banks, sovereign wealth funds, and large institutions decide they don't want paper promises anymore? They want the real thing, sitting in their own vaults, under their own control. That's what's happening right now. And it's creating a squeeze that most people don't see coming. Let me give you some numbers that should make this crystal clear. The COMEX, which is the major futures exchange where gold trades in the United States, has something called registered inventory. This is gold that's available for delivery against futures contracts. As of last month, registered gold inventory at COMEX sat at around 8 million ounces. 8 million ounces sounds like a lot, right? Until you realize that the open interest in gold futures, the total number of contracts outstanding, represents about 40 million ounces. So there are 5 times more paper claims than there is physical gold available to deliver. Now, in normal times, this isn't a problem. Most futures contracts get rolled forward or settled in cash. Only a tiny percentage of people actually stand for delivery. But we're not in normal times anymore. Delivery requests have been surging. In some recent months, we've seen delivery requests that would drain half the registered inventory if everyone actually took their metal. The exchange has had to scramble, moving gold from eligible inventory into registered inventory, bringing in metal from London, doing whatever it takes to meet delivery demands. And this is just COMEX. The same dynamic is playing out in London, in Shanghai, in every major gold trading center. The physical metal is getting tight while the paper claims keep multiplying. You want to know what's really wild? The banks that are short these futures contracts, the ones who've sold promises to deliver gold they don't have, they're paying a premium now to source physical metal. It's called backwardation, and it's extremely rare in gold markets. It means that gold for immediate delivery costs more than gold for future delivery. That's backwards from how commodity markets normally work. Why would anyone pay more for gold today than gold 6 months from now? Because they need it now. Because they have contracts coming due, and they need physical metal to deliver against those contracts. Because the paper game is starting to break down. Here's where it gets really interesting for anyone holding gold or thinking about buying gold. The institutions that understand what's happening, they're not buying paper gold anymore. They're buying physical. They're taking delivery. They're moving metal into their own vaults. Central banks have been net buyers of gold for 14 consecutive years now. 14 years. But the pace has accelerated dramatically in the last 2 years. In 2022, central banks bought over 1,000 tons of gold. In 2023, they bought another 1,000 tons. These are the highest levels of central bank buying in over 50 years. And it's not just the usual suspects. Yes, China and Russia are buying, but so are Poland, Singapore, India, Turkey, Egypt, Qatar. Countries that historically held very little gold are suddenly accumulating significant reserves. Why? Because they see what's coming. They see a world where the dollar's dominance is waning, where sanctions have weaponized the dollar system, where holding your reserves in dollars or euros or yen means your wealth can be frozen or seized at the whim of a foreign government. Gold can't be sanctioned. Gold can't be printed. Gold can't be frozen in a bank account. Gold is the ultimate neutral reserve asset. And in a world that's fracturing into competing power blocks, gold is the only thing everyone trusts. Let me tell you about something that happened in 2022 that didn't get nearly enough attention. When Russia invaded Ukraine, the West froze Russia's dollar reserves. About $300 billion, just frozen, inaccessible. Now you might think Russia deserved that. Maybe they did, but imagine you're a central banker in China, or Saudi Arabia, or India. You're sitting on hundreds of billions or trillions of dollars in reserves, and you just watched the West freeze another country's reserves overnight. What's your move? You diversify out of dollars. You buy gold. You buy lots of gold, because gold sitting in your own vault can't be frozen by anyone. This is the great monetary reset that's happening right now, not some conspiracy theory about a one-world currency, but a real, measurable shift away from dollar dominance and toward a more multipolar monetary system with gold at its center. The BRICS nations, Brazil, Russia, India, China, South Africa, they've been talking for years about creating an alternative to the dollar system. And while they haven't launched a BRICS currency yet, they're doing something arguably more important. They're accumulating gold. Massive amounts of gold. China officially holds about 2,000 tons of gold in reserves. But every analyst who studies Chinese gold flows believes the real number is much higher, maybe 5,000 tons, maybe more, because China has been the world's largest gold producer for over a decade, and all that gold stays in China. None of it gets exported. Where's it going? Into official reserves that aren't being reported. Russia has been even more aggressive. They've quintupled their gold reserves over the last 15 years. They've gone from around 400 tons to over 2,000 tons, and they've been very explicit about why. They want to de-dollarize. They want to reduce their vulnerability to Western sanctions. Gold is their insurance policy. Now, here's where this affects you, whether you own gold or not. Because what's happening in the institutional world, in the world of central banks and sovereign wealth funds, that eventually filters down to the retail market. It has to. When institutions are buying physical gold and taking it off the market, that gold isn't available for you to buy. When refineries are running at full capacity and still can't keep up with demand, premiums go up. When the ratio of paper claims to physical metal gets too extreme, something has to give. And what gives is the price. Because at some point, the paper price, and the physical price diverge. We've already seen hints of this. During the COVID panic in March 2020, gold futures were trading at $2,700 while physical gold coins were selling for over $2,000, a $300 premium for physical over paper. That was a brief dislocation. But what happens when it's not brief? What happens when the premium for physical becomes permanent? What happens when people realize that the gold price they see on their screen, that's just the paper price? The real price, the price for actual metal you can hold in your hand, that's something else entirely. Let me shift gears for a second, because if you're sitting on $100,000 or more in retirement accounts, this next part is especially relevant. A lot of people don't realize you can hold physical gold inside a retirement account. It's called a gold IRA. I put together a free guide on exactly how this works, how to get physical gold into your retirement account without triggering taxes or penalties. It's in the description below. Worth checking out if you're thinking about protecting some of your retirement savings with physical metal. All right, back to what's happening in the market right now. Because there's another piece of this puzzle that most people are missing: the mining side. Gold mining is a tough business. It takes 7 to 10 years to bring a new mine online. You've got to find the deposit, prove it up, get permits, build infrastructure, start production. It's a decade-long process that requires billions in capital investment. And here's the problem: we haven't been finding enough new gold. Major discoveries have been declining for 20 years. The easy gold has been found. What's left is deeper, lower grade, harder to extract, more expensive to produce. Meanwhile, existing mines are depleting. Every year, mines produce gold, and every year, those reserves get smaller. Eventually, mines run out. And if you're not replacing that production with new mines, total supply starts to decline. We're approaching that inflection point. Global gold mine production peaked around 2018 at about 3,300 tons per year. Since then, it's been basically flat. And most analysts expect production to start declining in the next few years. So you've got supply that's flat to declining, and you've got demand that's surging, especially from central banks and institutions. What happens when supply can't meet demand? Price has to rise. It's basic economics. But there's a twist, because gold isn't like other commodities. When the price of copper goes up, mining companies produce more copper. Higher prices incentivize more production. But gold? Most gold that's ever been mined still exists. It doesn't get consumed, it gets held. So when the price of gold rises, you don't just get more mine supply. You also get less recycling. People hold on to their gold instead of selling it. Jewelry stays in the drawer, coins stay in the safe. The higher the price goes, the tighter physical supply becomes. This is the opposite of how normal markets work. In normal markets, higher prices bring out more supply. In gold, higher prices can actually reduce available supply. It's a reflexive dynamic that can lead to explosive price moves. We saw this in 1979 and 1980. Gold went from $200 to $850 in less than 2 years. Why? Because physical supply dried up. Everyone who owned gold decided to hold it. The only gold available was newly mined gold, and that wasn't nearly enough to meet demand. We saw it again in 2011. Gold went from $700 to $1,900 in less than 3 years. Same dynamic: physical tightness, surging demand, limited supply. And we're seeing the early stages of it right now. Premiums for physical gold are elevated. Delivery times are extended. Refineries are backed up. These are all signs that physical supply is getting tight. But here's what's different this time. In 1980, the squeeze broke when Paul Volcker raised interest rates to 20%. That killed inflation, killed gold demand, and sent gold into a 20-year bear market. In 2011, the squeeze broke when the Fed started talking about tapering QE. That was enough to reverse sentiment and send gold lower for several years. This time, central banks are the buyers, and central banks don't sell because interest rates go up. They're not trading gold. They're accumulating it as a strategic reserve asset. They're buying for reasons that have nothing to do with short-term price movements. That's what makes this different. That's what makes this potentially much bigger than previous gold bull markets. Because the marginal buyer isn't a speculator who will sell when the trend changes. The marginal buyer is a central bank that's buying for strategic reasons and plans to hold for decades. Let me give you another data point that should make this clear. Gold ETFs, the paper gold products that retail investors buy, they've been seeing outflows. People have been selling their ETF shares. Meanwhile, physical gold demand has been surging. What does that tell you? It tells you that retail investors, the unsophisticated money, they're selling. They're looking at gold's price action, seeing it consolidate, and deciding to move on to the next shiny object. Meanwhile, the smart money, the institutional money, the central bank money, they're buying physical. They're accumulating the real thing while retail sells paper claims. This is exactly what you want to see if you're a contrarian investor. You want retail to be bearish while institutions are bullish. You want the crowd to be selling while the smart money is buying. Because that's how major bull markets begin. Think about what happened with oil in 2020. Retail investors were panicking, selling their oil ETFs. The price briefly went negative. Meanwhile, oil tankers were being chartered to store oil at sea. Physical oil was being accumulated by people who understood that the negative price was a paper market phenomenon, not a physical market reality. 6 months later, oil was back to $50. A year later, it was at $80. The people who bought physical oil when the paper market was panicking made fortunes. The same dynamic is setting up in gold right now. The paper market is consolidating, looking tired. Retail is losing interest. Meanwhile, the physical market is tight. Premiums are elevated, and institutions are accumulating. Here's something else that's happening behind the scenes that almost nobody's talking about. The dollar's reserve currency status is eroding faster than most people realize. It's not collapsing overnight, but it's declining steadily, year after year. In 2000, about 70% of global reserves were held in dollars. Today, it's closer to 58%. That might not sound like a big deal, but think about what it means. 12 percentage points of global reserves have shifted out of dollars in just over 20 years. Where did that money go? Some went into euros, some went into yen, but increasingly, it's going into gold. Because gold is the only reserve asset that isn't someone else's liability. Dollars are a liability of the US government. Euros are a liability of European governments. But gold? Gold is just gold. It's an asset, pure and simple. And in a world where trust in governments is declining, where debt levels are exploding, where currencies are being debased through endless money printing, gold becomes more attractive, not as a speculation, as insurance. Let me tell you about a conversation I had with a wealth manager who handles accounts for ultra-high net worth families. These are people with 50 million, 100 million, 500 million in assets. Old money, generational wealth. He told me something fascinating. 5 years ago, his clients held maybe 2 to 3% of their portfolios in gold. Today, it's closer to 10 to 15%. And they're not buying gold ETFs. They're buying physical bars and storing them in private vaults in Switzerland, Singapore, and the Cayman Islands. Why the shift? Because these families think in terms of generations, not quarters. They're not trying to trade gold. They're trying to preserve wealth across decades and centuries. And they've looked at history and concluded that gold is the only asset that's maintained its purchasing power over truly long time horizons. An ounce of gold bought a fine men's suit in Roman times. It bought a fine men's suit in 1900. It buys a fine men's suit today. That's 2,000 years of purchasing power preservation. No currency can make that claim. No government bond can make that claim. Only gold. Now, I'm not saying you should put your entire portfolio in gold. That would be crazy. But the fact that the world's wealthiest families are increasing their gold allocations from 3% to 15%, that should tell you something. These are people who have access to the best information, the best advisors, the best opportunities, and they're choosing to hold more gold. Here's another angle that most people aren't considering: the energy transition. Everyone's talking about electric vehicles and solar panels and wind turbines. What they're not talking about is how much gold goes into all of this technology. Gold is used in electronics because it's the best conductor that doesn't corrode. Every smartphone has a tiny amount of gold in it. Every computer, every solar panel, every electric vehicle has more gold in it than a traditional car because of all the additional electronics. As the world electrifies, as we build out renewable energy infrastructure, as we add billions more electronic devices, industrial demand for gold is going to increase. Not dramatically, but steadily. And remember, we're already in a situation where mine supply is flat to declining. So you've got central banks buying. You've got wealthy families buying. You've got industrial demand increasing. And you've got mine supply that can't keep up. At some point, something has to give. The question isn't whether gold goes higher. The question is, how much higher and how fast? Because the fundamentals are as bullish as I've ever seen them. The only thing holding gold back right now is sentiment. Retail investors aren't excited about gold. It's not the hot trade. It's not going up 10% a week like some cryptocurrency or meme stock. But that's actually good news if you're thinking about buying, because it means you're not buying at the top of a speculative frenzy. You're buying when the fundamentals are strong but sentiment is meh. That's exactly when you want to be accumulating. Let me paint you a picture of what I think happens over the next few years. I think we're in the early stages of a major gold bull market that could take gold to $3,000, $4,000, maybe $5,000 an ounce. Not because of speculation, because of fundamentals. Central banks are going to keep buying. They have to. They're trapped in a system where holding dollars is increasingly risky, and gold is the only alternative that's truly neutral and liquid at scale. The paper gold market is going to come under increasing stress as more people demand physical delivery. At some point, there's going to be a delivery failure somewhere. Maybe at COMEX, maybe at LBMA in London. And when that happens, confidence in paper gold is going to evaporate. When confidence in paper gold evaporates, the premium for physical overpaper is going to explode. We're talking about premiums of 20, 30, maybe 50%. At that point, the paper price becomes irrelevant. The only price that matters is the physical price. And once that happens, once the world realizes that most gold that trades is just paper promises backed by a tiny amount of physical metal, the scramble for physical is going to be unlike anything we've seen before. This isn't fear-mongering. This is just logic. If you have 100 paper claims on the same ounce of gold and people start wanting the actual ounce, 99 of those claims can't be satisfied. Those 99 people are going to have to go into the market and buy physical gold at whatever price they can get it. That's the squeeze that's building. That's what gold holders don't realize is happening behind the scenes. The paper market is a house of cards, and the foundation is starting to crack. Now, maybe I'm wrong. Maybe the paper market holds together. Maybe central banks stop buying. Maybe mine supply surges. Maybe something happens that I'm not anticipating. But I'll tell you this. The risk-reward on gold right now is as attractive as I've ever seen it. If I'm wrong, gold probably consolidates or drifts lower for a while. You might lose 10 or 15%. But if I'm right, gold could double or triple from here. That's an asymmetric bet worth taking. And here's the thing about gold. It's not going to zero. It's not going to get disrupted by some new technology. It's not going to go bankrupt. It's been money for 5,000 years, and it's going to be money for the next 5,000 years. So when you buy gold, you're not speculating on some company's earnings or some government's policies. You're buying the ultimate form of money, the one asset that survived every empire, every currency collapse, every financial crisis in human history. The institutions know this. The central banks know this. The ultra-wealthy families know this. That's why they're accumulating physical gold while retail investors are distracted by the latest shiny object. The question is, are you going to figure this out before everyone else does? Or are you going to wait until gold is at $3,000 and the premiums for physical are through the roof and the delivery times are 6 months? Because by then, it'll be too late. By then, you'll be buying at the top of the panic instead of the bottom of the accumulation phase. Right now, today, you can still buy physical gold at reasonable premiums with reasonable delivery times. That window is closing. Every month, it gets a little bit harder. Every month, premiums tick a little bit higher. Every month, delivery times stretch a little bit longer. The smart money is acting now. They're not waiting for confirmation. They're not waiting for gold to break out to new highs. They're accumulating while it's quiet, while retail is disinterested, while the opportunity is still there. This is your moment. This is your chance to position yourself ahead of what I believe is going to be one of the biggest wealth transfers in modern history. From people who hold paper promises to people who hold physical assets. From people who trust the system to people who prepare for the system to change. Gold is telling you a story right now. The physical market is tight. Central banks are buying. The paper market is stressed. The fundamentals are screaming that something big is coming. The only question is, are you listening?